Once again, members. So we are going to look at the administrative report, and the administration report it's basically updating members on any changes in the industry and in terms of how their scheme is managed. And being the administrators, so we'll be able to today take you through 4 items: the scheme features. We'll talk about how your scheme is structured and what is the benefit you being in this kind of pension scheme. We'll talk about the mortgage regulations. I know this has been there since especially last year and the previous years with the new mortgage regulations. So we are going to update members about the mortgage regulations in the industry. We also talk about the post-retirement medical fund. The sponsor talked about this, so we are going to expound more and see how you members you can benefit from it. We'll talk about the implementation of the NSSF Act. We'll try to expound more to the members about how the NSSF Act 2013 affected them and maybe the way forward on how the sponsor or your employer can be able to effect the same. So to start with, your scheme features, the scheme features that you as members participate in. So you are under what we call an umbrella benefit scheme, where your employer sets up a pension scheme through which you as the employees, you are able to save for your retirement. So in Britam, we have 2 sets of retirement schemes. We have a pension fund, which basically means that at the time of retirement, you will be able to access 1/3 of the accumulated benefits, and then 2/3 you are able to purchase a retirement product, either what we call an annuity or an income drawdown. All these products are normally are offered by Britam, so we can be able to offer those retirement benefits product to you. We also have another scheme we call a provident fund. Basically, the difference is that at the time of retirement, you are able to access a lump sum benefit of all your benefits that you have saved in the scheme. And then you are able to make your own decision, flexible, that you are able to either take the whole amount as a lump sum or decide to take an income or a retirement product for you. So in terms of contributions, so you are able to contribute through your employer, and also your employer is able to match the same. So both your employer and also yourself, you are able to contribute so that you save for your retirement. In terms of tax incentive, pension is one of the products which has some good tax incentives, so that members are encouraged to save more for their retirement. So the first tax incentive is that every contribution you make up to a maximum amount of 20,000, it's tax exempt from payee or from tax. So basically, a good example is, for example, somebody who is earning 100,000 and they decide to contribute 20,000 towards their retirement, then it will mean that that 20,000 will not be taxed. So it will be tax-free. It will be sent to their retirement benefits for savings and investment, so that they are able now to have more benefits at retirement. So in terms of exit, when you come back to withdraw your benefit, you also have a tax benefit. So every year that you contribute or you complete in a pension scheme, you have a tax-free amount of 60,000. So up to a maximum of 10 years. So if you have been contributing towards your pension benefits up to a maximum of 10 years, you have a tax-free amount of 600,000. Also, for those members who preserve their benefits until late retirement of 65 years and above, currently you will not be required to pay any tax, so you can be able to access your benefits tax-free. So those are some of the 3 major tax incentives that you have in a pension scheme. So in terms of accessing your benefits, you can access your benefits through 6 ways. So the first one is through withdrawal. So that is basically means you are exiting before retirement. That can be either through resignation, retrenchment, any other reason that you can leave employment before retirement. And in this case, according to the regulations, we'll process and pay 50% of your benefits. So 50% is 50% of your own contribution and 50% of the employer. So the remaining amount is still preserved for you. It will be earning interest until the time you attain an early retirement age. So we also pay through retirement. So retirement can be either early retirement, normal retirement, or late retirement. So early retirement basically starts at age 50. As long as you have exited employment, we'll be able to process 100% of your benefits. Normal retirement basically means the retirement age that is set by your employer. So once you attain that normal retirement age as set by your employer, you'll be able to access your benefits. Late retirement in Kenya is at age 65 and above, but depending on the organization and the company that you work with, it can vary. Because like for churches, schools, maybe the retirement age can be higher than the 65 years. In case of ill health, basically you provide a document from a doctor confirming that you are not able to continue with your work operations. And in that case, we'll be able to process and pay 100% of your benefits. In case of immigration, we'll be able to provide documentation to show that you are migrating from Kenya with no intention of coming back. So that can be either a permanent citizenship document or a permanent work permit. So with that, we are able to process your benefits and pay 100%. In case of death, your beneficiaries will be paid, and that's why always we are encouraging you members to always update your beneficiaries so that in case of such occurrence, your beneficiaries will be able to access your benefits. So your beneficiaries, it's a requirement by law that you update your beneficiaries so that in case of such occurrence that you are not there, the trustees can be guided on how your benefits are paid out. It also help to avoid delay of paying out benefits, because once we know who are the beneficiaries, the trustees will be guided to pay accordingly. And also, your pension scheme is not part of your estate. So you cannot put this in your will, that your benefits to be paid according to your will instructions. So this cannot be allowed. So that's why pension benefits are differently, and they cannot be part of your member estate. So with this, we also encourage members to make additional voluntary contributions. So additional voluntary contributions will help you to increase your tax efficiency. So meaning we say that you have a tax-free amount of up to 20,000 every month that you are contributing. So if you are able to increase further, even in excess of the 20,000, it will be an advantage to you because you'll be saving more for your retirement. It will boost your retirement income because the more you save, the more income your benefits generate. It's portable, meaning you can be able to move with your voluntary contributions to your next employer to an individual pension scheme, depending on how you want to treat your benefits. Also, voluntary contributions are very flexible because you can always advise your employer, your payroll manager to always vary. That is meaning increasing the contribution, to stop or to also start. So it's very flexible so that you are able to guide it by yourself. So having said that, I'll mention about the retirement income options that we have at retirement. So we have two types of retirement options. The first one is an annuity. An annuity is a regular pension paid to you at retirement so that you can always have an income, a regular income at retirement. And we look at so many key features before we say that you are a particular member with the amount of money that you have. This is the monthly or periodical payments that we are able to pay you. And this is common because, number one, the key features of an annuity, it's irrevocable and also it's paid for life. So once you are able to sign up for the annuity, you'll be paid for life. As long as you are alive, you'll always be paid. But the key features we look at is that you have to pick a guarantee period. A guarantee period is basically securing your beneficiaries such that in case you are no longer there, they'll be able to be paid the remaining investments you are putting for your pension. So the maximum guarantee period is 20 years, but you can always choose either 0, 5 years, 10 years, up to 20 years. The higher the income, the lower the guarantee period. So that's why we are trying to secure and reduce that risk for you. You can also choose two types of annuities. You can either choose a single type of an annuity where you, as the principal member, you'll be paid for life. You can also choose to have a joint life annuity. So that means you and your spouse, you always get the monthly contribution or the monthly payments. The other type of income option is an income drawdown. So this is a 10-year locked investment where you are able to draw down contributions up to a maximum of 15% per annum. So with this, after the 10 years, you are able to make a decision of either to be paid the remaining amount or to continue with the product. So the key feature of this product is that you are able to track down the investment of these savings, and also you are able to track down on how you are paid, because from the name itself, you are drawing down what you have invested for your retirement. So these are very, very key and very beneficial because when we are working, we are used to a regular salary. And with these two products, you are able to be paid either monthly, quarterly, semi-annually, or an annual payment, so that you are used to that regular income at retirement. Having said that, I'd also like to mention about the mortgage regulations. We had the first mortgage regulation where you are able to access up to 60% of your benefits to use that as a collateral. So you are not being paid, but you are using 60% of your benefits as a secondary collateral. So basically what that means is that you approach your financial institution, either your SACCO or your bank, and if the bank is able to allow use of your mortgage, use of your pension as a secondary security, you are able to apply the same through the Retirement Benefits Authority, so that now you are able to use your benefits up to 60% as a secondary security. We also had another benefit where you could access or withdraw 40% of your benefits to purchase a residential house. But as of 23rd November 2022 last year, the High Court quashed this amendment because of several reasons. So at the moment, the second benefit where you can be able to withdraw up to 40% to purchase a residential house was quashed, and we are still waiting for the next decision from the High Court, so that now we are able to effect the same. But at the moment, the only benefit you have to access or to purchase or to build a house for your retirement is the first one, where you are able to use 60% as a secondary collateral. The next benefit, or what I like to talk about, is the post-retirement medical fund. And this is a product or a benefit that you, as the members who are under the pension scheme, have, where you can voluntarily contribute towards your medical fund at retirement. So basically how it works is that we have already set this fund within Britam. We call it Britam Afya Pension Fund, where you are able to voluntarily contribute any amount so that once you attain the retirement age, you are able to utilize that amount for your medical retirement. So for example, if you contribute 1,000, 2,000, maybe 5,000, whichever amount that you have, the same amount will be invested, just like the pension funds are invested. And then a statement is shared on a yearly or need basis, so that you are able to track down how much have you saved, so that once you retire, you are able to utilize that particular amount to purchase a medical fund or to utilize it for your medical expenses. But at the time of retirement, the regulations have also allowed that you can transfer up to 10% of your savings towards the medical retirement fund, so that you are able to have a medical cover at retirement. Remember, members, that at the moment, since you are currently working, you are getting a medical cover with your employer. But also it's good to think about this, because once you retire, that medical cover will not be there, and you'll need now to foot your medical bills. So to secure that, you can be able to start investing right now. So we are encouraging members to do this through their employer. We have several members who have already in this type of saving. So if you have not done that, since it's voluntary, kindly take note of the same, so that you plan and start planning for your medical retirement right now. Having said that, I'll talk about the next topic on NSSF 2013 Act. And this topic is wide right now. It's almost every every employee is talking about. And just to give a background about NSSF 2013 Act, this was enacted in 2013, but because of court cases and all that, it became effective or implemented on February this year. So as of from February 2023, your contribution to NSSF increased, and you can be able to attest to that from your pay slips. And that's because of this ruling from the Court of Appeal to effect or reinstate the Act. And the NSSF Act was very particular, because they are trying to achieve a 6% contribution in the next few years, so that members are able to save more for their retirement. But just to give you the contribution model on how this NSSF was set up, so we had we have two parts of this contribution. We have the NSSF Tier 1 contribution, where basically we are targeting minimum basic level of benefits, and minimum basic level of benefits have been set by NSSF. So 6% will be applied on the minimum or basic level of benefits, and that will be submitted mandatorily to NSSF. The second part is what we call the NSSF Tier 2 contributions, which basically targets the level of income replacement. We call it the upper earning level. And with this type of contributions, these were now NSSF together with RBA gave a leeway that if you have a private pension scheme, let's say that the one you have with Britam, you can be able to contract out so that the Tier 2 NSSF contribution can be invested within your private pension scheme. So currently, from February to the end of the year, this is how your deductions to NSSF will look like. So having talked about Tier 1, which is 6% of the minimum income benefits, which is 6,000, you'll be required to contribute 360 shillings to NSSF, and also your employer will match the same. Tier 2 contribution is basically 6% of the upper earning limit, which is 12,000, which will be now 12,000 times 6% at 720 shillings. So in total, from your payslip, you are being deducted 1,080 to NSSF, and also your employer will match the same. So I talked about that at the long run that members are supposed to be contributing 6% to NSSF from their gross basic salary. So if you look at the progression that NSSF have given, is that the contribution will be changing each year until the 5th year, depending on your basic gross basic salary. So the first year we are talking about 6,000. Next year it will increase to 7,000, 8,000 in the following year until we are at 9,000. And also the upper earning limit basically is the 50% of the national earning, average earning. So in 2013, the national average earning was at 36,000. So meaning the 50% of that will be 18,000. So let's give just an example so that you are able to follow on how the deductions are being done. So the first example is for somebody who is earning 100,000. If your gross basic salary is at 100,000, the first year you will be deducted 1,080 shillings. So this 1,080 shillings is based on so many factors. The first factor is that the lower earning limit in the current year 2023 is 6,000, and then the upper earning limit is basically 50% of the national average earning, which was at 6,000. So which was at 6,000. So the 50% of that will be 18,000. So 6% will apply on the first 6,000, and then the difference between 18,000 and 6,000, which is 12,000 basically, 6% will apply on that. So meaning the first year will be deducted 1,080, and remember the employer will have to match the same. The second year, that is next year 2024, this contribution depending on your basic salary will double. So basically we are looking at the increase in 50% of the national average earning to 36,000. So depending on the salary that you earn, that is basic salary, the contribution will double to 2,160. Looking at the year 2025, it will also double to 4,320 until we get to the fourth year, where now 6% of your gross basic salary will be submitted to NSSF contributions. So what we are trying to explain here, members, is that eventually the contributions to NSSF will increase to 6%, and because NSSF has also given a leeway to contract out, since you already have an existing pension scheme, Tier 2 contribution, which is basically most of your contribution can be channeled to your private pension scheme with Britam. So let's give an additional example to the most basic contribution, or earner, that is somebody who's earning 10,000 per month. So basically this person will contribute 6% of their earnings to NSSF. 6% basically meaning the tier 1 contribution will be submitted to NSSF, and then tier 2 contribution can now be contracted out to your pension scheme at Britam. So what we are talking about now is about contracting out of the tier 2 NSSF contributions. And Britam has already been approved by the Retirement Benefits Authority, and we are now able to have your employers, have your sponsors contracting out to the Britam umbrella scheme. So contracting out basically involves the management or the employer applying for your organization to opt out of the tier 2 NSSF contribution. And after application, we submit these documents to RBA, Retirement Benefits Authority, and within 60 days of notice, then you are able to get to start contributing to Britam for your NSSF tier 2 contributions. So we have already done this to several employers, and they have received certificates so that now they are able to continue to save for their members through the pension scheme. So the process is seamless. As mentioned by our sponsor, we'll be able to come in as relationship managers to help you out to fill these required application forms, to educate your members on the effect and what this means to them. But just for your knowledge, what is the benefit of contracting out, and why should we consider Britam and not NSSF? So we have several reasons. The first one is the prompt support in this process. We'll be able to come in as Britam to help you feel and understand this process and what this means to you. You'll have a dedicated relationship manager, a pension expert to guide you on both NSSF and retirement benefit scheme for your private pension scheme. You'll have superior returns. As mentioned by our investment manager, we have a guaranteed rate of 5%, but also at the end of the year, we always declare higher than that. So like last year, 2022, we declared an interest rate of 8.5%. As self-service portal, we have my Britam app and also the customer portal, where you are able to log in, be able to view your statement on a regular basis, be able to view your benefits, be able to know who are your beneficiaries so that you are able to update. We have free member education sessions. We call it member education forums, where we can come in as Britam without any cost to your members or to your sponsor or your employer, and educate you on any updates from the industry, both for NSSF and also for your private pension scheme with Britam. The post-retirement plans, we also give statements and settlement of your benefits. So once somebody exits from your benefits, especially the private pension scheme, we normally settle benefits within 10 working days. Transparency in all dealings by sharing statements, by updating new members on all the aspects surrounding NSSF and also Retirement Benefits Authority. So having said this, and having now the knowledge of your pension scheme and also NSSF, then how much is enough for your retirement? Sometimes these are questions that most of you ask a lot, that I've saved this much, then how much will I need so that now I be able to live the comfortable life I am at the moment in retirement? So statistics have given that you at least need 70 to 80% of your basic salary right now at retirement. So whatever you are earning right now, for example, if it's 100,000, you at least need 70 or 80,000 so that you can still maintain your current living standard at retirement. So this basically to avoid old age poverty, to make sure that at least you have a plan for retirement, there's no uncertainty. To maximize the tax advantage, as I mentioned, you can always do additional voluntary contribution so that you take advantage of the tax advantages which are there. And also, and you can attest to these members that if you have a good financial stability at retirement, even your life expectancy at retirement increases because you are not stressed about finances. To complete this, I'd like to challenge you members that we don't only talk about financial investments alone. At retirement, there are three key areas that you need to look at, like a three-legged stool. You need to look at your financial stability. That's what we have talked about right now. We also educate members on social, how social do you connect with people after retirement? When you retire, where do you want to go? Is it you still maintain the urban area, or you want to go to your local area, and are you familiar with the people in the surrounding? So that is what we talk about, the social leg. The community is how do you relate with your people, or the people where you retire to at retirement. So we can always come in and always educate you members about these three aspects, very, very key at retirement. As I conclude, I'd like just to look at a few statistics about those people retire. If you retire right now, where are most of the people? So almost 50%, that is 47%, depend on relatives. Remember previously, our parents used to, educate people so that the children can help them at retirement. So basically, this is just like a recurring thing. So that's why most of the people depend on their relatives once they retire. 31% still go back to working. So you get somebody who was working like an auditor, and then they go and set up an audit firm to continue with the work. So that 1% basically go back to work. But now where we are trying to aim as Britam is now at the remaining two parts, that is financial independence. We want to have more retirees have financial independence. We want to have more retirees depending on their pension. So that's why those are the smallest, categories in the market, but we want to increase them. And we want you as members to be part of these two categories. You depend on your pension, and also you are financially independent at retirement. With that, I'd like to give it back to the chair.